Mortgage rates are currently being kept artificially high by the Federal Reserve, and in this video I'm going to explain exactly how and why, but first you need to understand a couple of key concepts. Back during COVID, since a significant amount of the economy was shut down almost overnight, the Federal Reserve had to do everything in their power to stimulate economic activity to prevent the economy from going into either a recession or even a depression. Now, two of the tools that they used was number one, to cut Fed funds rate effectively down to zero, which would stimulate economic activity and borrowing and spending. And on top of that, they also built up their balance sheet by buying things like the US Treasuries and mortgage-backed securities. Now, whenever you buy things like treasuries and mortgage-backed securities, it pushes the price of those assets up, but the yield is inversely correlated with the price, and that means the yield went down or the interest rates went down, which also further stimulates borrowing and economic activity. Now, to focus in on the mortgage-backed securities, first you need to understand how mortgages are handled. The way this works is banks and other lending institutions create these mortgages, they package them up as mortgage-backed securities, and then they sell them off to other investors. In order to be able to attract other investors of these mortgage-backed securities, they need to charge higher mortgage rates than safer investments such as high-yield savings accounts, such as CDs, or even US Treasuries. However, that spread between these safer investments versus mortgage-backed securities, they were able to squeeze that down because they knew they had this unlimited wall of demand coming from the Federal Reserve. So that artificially pushed mortgage rates even lower than they otherwise would have been, which also stimulated more borrowing and economic activity. To give you an idea of the numbers, the Federal Reserve added about $1.3 trillion to their mortgage-backed security balance sheet since the beginning of the pandemic until about 2022 when it hit its peak. Since the pandemic was effectively deemed over and the economy went back to normal, instead of purchasing these mortgage-backed securities, the Fed allowed them to roll off their balance sheet and has ever since been letting their balance sheet for mortgage-backed securities decline. At this point, the Federal Reserve has rolled off about $600 billion from their mortgage-backed securities. So you can imagine now, banks who were selling these mortgages at a reduced premium above those safer investments because they had the Fed waiting to buy them, now must charge a higher interest rate in order to attract regular investors or institutions to buy these mortgage-backed securities. So as long as the Federal Reserve keeps letting these roll off their balance sheet, mortgage rates are going to be kept artificially high so that they can continue to attract investors. However, if the Federal Reserve decides to just level off their balance sheet or even start quantitative easing where they buy back these mortgage-backed securities in high volumes again, then mortgage rates are going to continue to remain artificially higher than they otherwise would be.